I started writing about bonds back in 2019, in some cases a little bit earlier. And I had an article in the middle of that year basically saying, are we in a bond bubble? And I went through the whole thing where, we had, $18 trillion in negative yielding debt out there. Magazine covers were saying inflation's dead. And I kind of reviewed this whole possible thing. I was like, inflation is something that in extreme environments, fiscal and monetary authorities, especially when working together, can generate, quite well if they get to the point where they need to. And, we got the catalyst the next year in 2020. And ever since then, we've been off to the races in terms of the amount of monetary expansion, the broad layer, not just base money, but broad money expansion, more money in people's pockets. Then combined with various inflationary forces like an energy crisis and kind of a reversal of some of these offshoring globalization trends, which keeps downward pressure on labor prices domestically. And so when bonds are yielding next to nothing and inflation is reaching 4-decade highs, I think it's natural for those yields to want to push up, because even after this crazy sell-off, those yields are still below at least current inflation. Now they're above forward inflation expectations, but forward inflation expectations has not been particularly accurate in recent years. And so I think it's a combination of, one, trying to deal with the inflation, and two, some of it's mechanical. Some of it is, as central banks are trying to fight that inflation, they're trying to not buy as many bonds or even let some bonds mature off their balance sheet. And so now you have basically oversupply of bonds, large deficits, and then you have some of the biggest buyers not selling. Not buying. And then when you go to some markets, like for example, the US Treasury market, foreign countries use those treasuries as like a ballast for their own currencies. So when the dollar is weak, they're generally accumulating treasuries. And when the dollar is very, very strong, like it is now, especially compared to many other developed market currencies. So ironically, some of the emerging markets are actually holding up better. But the dollar is very strong relative to a lot of these other currencies. And so what they do is, first they stop buying treasuries, and then two, they can start letting treasuries mature off their balance sheet. They can sell some of the shorter duration stuff that they have, and it gets bad enough they can even sell some of the long duration treasuries. And so you have a lack of a foreign bid for treasuries. And so basically in this environment, it's a very toxic combination for the sovereign bond market. I would say that, again, going back to 2019, I was saying that whatever excess there is in equities, I was more concerned about the bubble that's in sovereign bonds, because when you have, for the first time ever, like negative yields, or in the United States, like record low yields, and I was at long horizon, I was seeing inflationary pressures possible to start building. It's just a toxic combination, and it's funny. It surprised even me with how rapidly it happened, and part of that is because we got certain catalysts that they were even more rapid than we could have gotten. Like again, the energy crisis in Europe and the war in Europe. You had 40 years of kind of structural disinflation. And you had periods of inflation in there, like the 2000s decade, but you still had a structural disinflationary trend. So we had structurally falling interest rates, higher and higher debt relative to GDP, globalization. A lot of these were disinflationary forces. Aging demographics, for example, in some cases can be disinflationary. There's actually some nuance there that they actually can be inflationary in some cases. But we had a 40-year period of kind of like the great normalization, the great disinflation, and kind of my contention is when we run into the next issue back then. So I was saying 2019, when we run into the next problem, there's not a lot of wiggle room here, and so we're probably going to get some more inflationary types of fiscal policies. And then also when you look at the kind of the long-term commodity cycle, right? So there's periods of overinvestment, there's periods of underinvestment. Some of these longer-term projects take many years to come online, so there's kind of a natural rhythm to commodity markets. And what I would generally see when I looked out on research is I would see very siloed research. So I see people making disinflationary calls. They're not talking about energy capex at all, right? It's just completely off their radar in many cases. And then you go in other areas and say they're not very familiar with bond market dynamics or things like that. And so when you kind of put some of those pieces together, it just wasn't a very attractive situation for bonds. Even going back, say, 40 years, the type of inflation we had this time is quite different than the 1970s inflation. So a lot of people that were kind of, when they were determining whether or not inflation is going to happen, they were looking at the 1970s and saying, well, we don't have those conditions, so why would we get inflation? And it's like, well, go back to the 40s and you'll see why we were going to get inflation. And so that was, in my view, the 1940s were the closest analog. And the big difference there is that in the 1970s, inflation was in large part coming from peak demographics. So baby boomers entering the workforce, buying tons of homes, a lot of banks lending, and therefore a lot of money supply growth from banks lending. And a lot of people said, none of that's happening, so we can't get inflation. And it's like, well, the other level of inflation is like the 1940 style inflation, where you have absolutely massive government deficits that are monetized and supported by the central bank. It pours money into the economy, goes around the banking system, or in Russell Napier's view, it supports the banking system, but you can also just go around them pretty much, and it just puts more money in people's pockets. And then you add, it's basically wartime finance. And so in 2020 and 2021, we had wartime finance in response to lockdowns and things like that. Basically, if you just showed me charts what was happening, it looks like a war. And of course now we have actual war, which is also inflationary because it's malinvestment. It adds frictions, it reduces productivity, it reduces global efficiency. So this is a very inflationary cocktail.
In the 1940s, there was yield curve control, so yields wouldn't spike higher. What happened in 1946? If, let's say, we're coming out of this sort of wartime thing where we're monetizing the debt because the Fed is not buying treasuries now, they're reducing their holdings, they're doing quantitative tightening, QT, instead of quantitative easing, QE. What happened in 1946, and is it a good analog for 2022 and 2023?
Well, so there were a variety of periods throughout that time. So they actually didn't fully let go of that financial repression really until the early 1950s. And it was actually that's when it became a political struggle, because you had the Fed wanted to get independent again. So during the war, essentially the Fed lost independence more or less, and they wanted to reassert that independence. And the Treasury was like, well, not yet, not yet, not yet. And so you had this environment where they were still running this kind of inflationary playbook. They were still holding yields lower than the prevailing inflation rate, and eventually you had a separation. But that took several years to manifest. And there were kind of the year-by-year playbooks, what was happening each year. But essentially, I when it comes to analogs, I try not to match things up year by year, right? It's more about the broad paintbrush, right? So obviously technology is very different than the 40s. The type of reason for the financing is different than the 40s. The political environment is different than the 40s. I've often said that the U.S. today looks more like the U.K. of the 1940s, which is the incumbent power and the structural trade deficit power, whereas back in the 40s, the United States had a structural trade surplus. So there are things that are different than that environment. But the short version is it's kind of like a Hotel California, where it's very, very hard to get out once you get into the situation. Basically, the reason they were able to get out back then is because they didn't have that top-heavy entitlement program. So after the war was over, they were able to start getting a handle on the budget. Federal debt never went down nominally in any significant degree, but they basically managed to hold it flat for a number of years as nominal GDP, partially from real growth and partially from inflation, caught up to it, essentially. So you lowered the debt to GDP that way. And the problem now is that we're still running, in the United States, $1 trillion deficits with no end in sight, because it's in addition to these kind of one-time programs, we also have this background overlay of $1 trillion deficits that are largely due to our structural budget issues. You can look at Japan, you can look at Europe, parts of Europe, and it's kind of the same problem. And now Europe has an acute energy crisis, which is kind of like a wartime situation. If you can't produce things at reasonable prices compared to the rest of the world, and if people can't afford their heating bills and can't afford to keep the power on, and you have some degree of demand destruction from companies shutting down. So in many cases, this continues to resemble the 1940s, and I think I'd probably still in the early 1940s. If anything, I think we're still, the war's not over yet, right? So this is not like 1945, 1946. This is like a wave one, I think, of this dilemma. I think the war ends when the energy supply situation is more resolved and some of these geopolitical things are more resolved. And then probably also when you've inflated quite a bit of the debt away, which is, I think, we're nowhere